One of the more common and important concepts in generally accepted accounting principles is the revenue recognition rules. These are a series of rules that help determine when businesses can report their revenue, or, in other words, when they record sales. When you go out shopping at a store, you usually select an item from the shelf, go to the register, pay the clerk the money right then, and walk out with the product. It is easy to know when a sale takes place because the money and the product change hands at the same time. But what if the customer prepays for the product months before the product is actually delivered to them? Then when do we record the sale? Is it when we receive cash or when we deliver the product? And what about if the customer buys something big that takes a long time to build, like a new house? Does the builder record sales when they start building, or only when the house is done months later? Or can they record sales while the house is being built? Revenue recognition rules exist to help us answer these more complex sales scenarios. Revenue recognition essentially states that a sale takes place when it is realized and earned, not necessarily when the cash is received. A sale is considered realized and earned if there is a specific and agreed upon dollar amount that is measurable, and if a critical event has occurred that can identify some completion on the part of the seller. If they are selling a product, that event might be delivering the product. So in the case of prepayment, for example, the sale would take place when the product is delivered later, even though the customer paid for the product ahead of time. If they are selling a service, typically the critical event is when the work is done. When the job takes a long time though, like the house, sometimes they can measure specific stages of the project and use each one as a critical event to receive a percentage of the total sale when each event is complete. Revenue recognition rules can be very complex, and some accountants dedicate their entire careers to specializing in this one area of GAAP principles. For now, though, the important thing to remember is that a sale takes place when it is realized and earned, and not necessarily when the cash is received. That's the revenue recognition rules. For more information about GAAP standards and other accounting topics, check out more of my videos on YouTube or visit torinorman.com.